Hello, guys, and welcome. It is Live at 5. The Educated Home Buyer is what we're calling this now. Myself, Jeb Smith, Josh Lewis, our mortgage expert. We appreciate you guys being here. Thanks for tuning in. For those of you who are new, we are here to answer mortgage and real estate related questions. Read your comments, laugh, have a little fun. Josh, welcome to the show, my friend.
Thanks for having us back. It's been a hectic week. It seems like Wednesday arrived extra early this week.
Every week, man, it flies by. It flies by. So we've had a little bit of, news out there, right? So last week, we got PPI numbers, CPI numbers. I don't think we've talked since then. Maybe we did. I don't remember. But most recently, the Fed minutes have come out for February. And inflation's obviously the topic that everyone is talking about, not only the Fed, everyone, essentially across every industry, right? Because we are at high levels of inflation. Some people thought that the Fed might do something sooner. They've essentially addressed, the concern that's out there and more or less assured everyone that it's coming in March. So that's what we all have to look forward to, right? But I'm under the belief that I personally think we've peaked with regards to inflation. I don't know that we'll see any numbers higher than what we've seen already, just because every industry is really thriving. I don't know how industries could really do better than what they're doing at the moment, but opinions on that, we can lead into interest rates and kind of dive into it in a little bit more detail and then get to some questions.
Yeah, the big thing, Jeb, is the key to understand how they calculate those numbers. So last week, I believe it was actually on Wednesday, because I think we did talk about it on the show last week. We had the CPI figure. CPI, Consumer Price Index, comes in at 7.5%. Hottest number since 1982, 84. Long time. Hottest number in a long time. Then Monday, we had the PPI figure, even hotter relative to expectations than what we saw in CPI. And that's Producer Price Index, which theory has always been it's sort of a preview of what's coming in CPI further down the line. But the important thing to know is how these numbers are measured. They basically are taking an average of the month-over-month figures. And the reason why a lot of these numbers are super hot is because we were coming off of extraordinary low numbers in 2020 and replacing them with much bigger numbers in 2021. So as that effect wanes, it is incredibly likely that inflation is going to normalize. So the question becomes, what's normal? For the last 10 years, post meltdown 2007, 2008, normal has been about 2%. When it got hot, it was up around 3%. And when it was bad, it was just a little over 1%. So that's normal in the long run. And I've said before here, week after week, I expect that, in the long term, that number is going to get even lower because of the number of deflationary forces. But the question is, everyone likes to mock the Fed last year for saying inflation is transitory. Well, what's the definition of transitory? Just make it simple. It means not permanent. So this is not permanent. So does transitory mean 3 months, 6 months? That was what most people took them to mean last year, and which they probably did mean when they said it. But now we're going on a year, and we could have another year. We could have another 3 years of much higher than normal numbers, normal being 2%. So what do we care here on this show? We care from the perspective of how much spendable money do we have, wage inflation, what are the things we have cost, what does it do for interest rates, and what does it mean for you buying a home? Right now, we know what it looks like. And the crazy thing is, I don't have the chart here right in front of me, but treasuries, so the 10-year treasury, like if we're looking at what we look at real rates of interest. So if you say the 10-year is at 2.02 right now, if inflation's at 7.5%, that means investing in treasuries, 10-year treasuries, gives you a negative 5.5% return. So think about that. That's 10 years out in the future. If the markets thought 7.5% inflation was permanent, or even 3.5% inflation was permanent, no one would be buying 10-year treasuries at 2.02%. So it's telling you that the smart money says this is transitory. It's going away at some point. So more importantly, what we want to look at if we go back here, where was it, the 10 sort of best case was back in December. I think we were as recently as December, we bottomed at 1.35. So it's up 0.65%. We talk all the time, Jeb, about how treasuries, mortgages track treasuries. They stay very close to each other. So if a 0.65, we were at probably 2.875 to 3% in the middle of December. 0.65 would be at 3.65. And everyone would go, well, that's not fun. That's not comfortable, but that's not terrible. But you see the headlines everywhere. For the most part, 30-year fixed mortgages on non-government loans, non-FHA and VA, are in the low fours now. So what happened? There's two pieces to it. Mortgage-backed securities that are also bonds that trade, that investors buy. People are more worried, investors are more worried about those than they are the 10-year treasury, so they've performed worse. So maybe that says that rates should be up 0.75 or 0.875%. We're up even more than that. One of the things that, Jeb, you and I talked about when the pandemic first jumped off, the spread between treasuries and your average mortgage interest rate over time averages about 1.75, 1.8%, right. and on the low end about 1.5, and on the high end about 2.1. So somewhere in that range. That's a normal range. Well,
so we're at the top of that at the moment.
We're not yet to the top of it. So the spread right now, if we say, last week, so again, there's a lag in the chart here that I'm looking at. It stops at the 10th of February, and that's a week out of date when they post it. So we'll get a new number tomorrow, and it's going to tell us, you're right, we're at about 2.25. And yeah, we are at the high end of that range. And why is that? That's the question we got to answer. Why is that? And is that likely to be permanent? Right now, lenders making mortgages and needing to sell those, and mortgage-backed security purchasers in the secondary market, their big concern, and we got a little preview of this with the Fed minutes today, is that the Fed is going to start selling their mortgage-backed securities. And so we have additional supply in the market due to that uncertainty. I do believe the Fed intends to do that. I do not believe the Fed can do that. It would create large problems if they start selling large amounts of mortgage-backed securities. So those are the things that we look at. If we think inflation has peaked, interest rates probably should have peaked. When I say probably, the hedge there is if the Fed says, hey, the economy is awesome, and we can sell treasuries and sell mortgage-backed securities, we can see rates go even higher. And if you look at where rates have been over the last week, every day they try to get worse, but they come back towards the afternoon, or they try to get better in the morning and they get worse in the afternoon. A very narrow range for about 4 or 5 days. Markets don't really know what's coming next, and a little bit of uncertainty. So I think the worst is behind us, but we could have a little bit more pain to go. But at some point we should recover. We're not going to go back anytime soon to what we saw as recently as December, but we should get back to what we thought were the long-term thoughts of 3.75, 4% versus the low fours. No, I mean, yeah, that's all good information. So hopefully, the
average person out there listening understands all of that. I mean, at the end of the day, I think what we're both saying is that, again, not speaking for Josh, but we think that the highest inflation readings are probably right where we are now. And I think the Fed probably believes the same. And the reason that they haven't reacted any sooner, right? I mean, they're obviously looking at a lot more information than you and I, but at the end of the day, this month is going to fall off and you're going to have a month over month change in inflation, and it's probably going to go down. And if the Fed does hike rates in March, which I think they intend to do at this point, I personally think the market will feel probably a little bit of security, if you will, that, hey, these guys are going to do what they said they were going to do. And hopefully some of that irrational selling and irrational moves in interest rates and all of that, calms down a little bit, right? A little stability in the market would be a good thing. Now, I don't know that you're going to see rates drop immediately, but what you want to see is less of the volatility. We saw 0.5% in like 2 weeks, right? I mean, it was hard. I mean, for any buyer out there, you got pre-approved, you probably thought, hey, great rate, low threes, and the next time you check, you're like, what? I mean, my payment went up by how much? And that's the reality. And so just, if you are a buyer out there, you've been looking, maybe you were looking months ago, maybe you were one of those buyers that I have that was looking back third quarter of last year, putting in offers, things have changed. So just make sure you're talking to your lender, having those conversations, getting updates so that when you put in an offer, you know what to expect. So,
and those Jeb, are the least pleasant conversations to have.
oh, I'm sure.
For me, and then for you to then have, let's say we have a couple clients that we got pre-approved in October and November. They weren't able to find anything, or at least able to get an offer accepted, and they just popped back up at the end of January and are saying, hey, we'd like to start looking again. And I'm like, okay, the first start is let's adjust to what the new normal is. On a $500,000 or a $700,000 loan, we've seen about a $400 or $500 increase in the monthly payment. And for some of you, you're like, whew, you are rich people getting $700,000 loans. We have entry-level first-time buyers here in Southern California. They're getting $700,000 and $800,000 loans. So it's a real change from last year. And we're going to watch it play out through the remainder of the year. And every week we'll show up and we're going to do exactly what we do here today: unpack the data, what happened, how have the markets reacted, and what is most likely to come from that moving forward. We don't have a crystal ball, but both Jeb and I, 20 plus years in this business, you kind of get a feel for how markets react and how things are going. It's not a guarantee, but it gives us a pretty solid idea of what comes next.
No, for sure. And for those of you who watch this every week, I always talk about inventory, right? Inventory is by far the key driver in this market, right? We've seen, everybody's been hammering interest rates. Interest rates are what is driving this market, and they are a factor. But interest rates have risen nearly 1% in the last 6 weeks. But the key here, and the market is still moving full steam ahead. And anybody in Southern California knows this, right? I will say it just so you know, markets are local, real estate's local. So what I'm seeing here might not be in your market, but what I can tell you, even with rates rising, inventory, it's going down, right? So every week I update you on Orange County, on Huntington Beach, where I am, not because you're here, but just to show you what's happening, right? Orange County today, as we come on the show right now, 1,262 active listings. That's about where we were last week. I don't remember the exact number, but it was in the 1,200. So whether it was low or high, it's about the same. Huntington Beach, I think we were in the 90s. Today we're 83. So here's the deal, guys. Beginning of the year, we were at about 69 listings. We creeped up as high. I think I saw as high as 115, 120. We're back down to 83. So inventory has gone on the market. Supply has come on the market. It's being met with demand. Why is it being met with demand, even though, rates are rising? Well, for one, there are buyers out there that believe rates are going to continue to rise. There's this FOMO, if you will, the fear of missing out, not necessarily on property, but on a lower interest rate, right? The idea that, hey, my rate is going to continue to rise. I might not be able to get in. I'm doing this now. That's real. I could tell you from talking to buyers, from having listings out there. I had a listing that I just put on the market here locally in Irvine. We had 22 offers in less than 2 days. And the reason we didn't have more is because people were calling me, telling me where their offer was going to be. And I was essentially saying, you're not even going to be in the game. So, I mean, not to say not waste your time, but that's what it came down to, just because of the demand. And we're talking numbers here, hundreds of thousands of dollars over the asking price. And we're going to talk about that in more detail. But Josh, anything you want to add to this before we dive into some questions?
What I would say is we have a lot of, both of us are in California. So a lot of the viewers here, a lot of you are in California. It's probably 50-50, Californians versus outside of California. One of the numbers that came up, Black Knight does a number every month, and this is for January. So before the rate spike, before the bump that we've seen in prices here at the beginning of the year, and looking at the payment to income ratio by state around the country. And there are high price states where things are about 29% of the housing payment to household income. But a lot of the states, Texas still at 22%, Arizona, where even though it had a lot of appreciation, 29%, Idaho, 33%, Minnesota, 18.8%. So affordability through most of the country is really good. You notice I didn't mention California. California's at 43%. Payment to income ratio. So a piece to remember, you go, oh my God, what are those crazy Californians doing? Remember that we have more renters in California than you have in other states. So that brings down.
We have more renters than you have people.
We have a lot more renters than you have people. But as a percentage of the population, more people rent in California due to the high home prices. So just think, long way of saying, due to higher rates and inflation, Californians have it harder than everyone else in the country by a good bit. We're at least 12% higher than any other state in the union here. So looking at that, for those of you outside of California, yes, it's worse than what it was a month or 2 months ago. But it could be worse. And for Californians, Jeb, we'll get into this, talk about it. What are the alternatives? We've also seen some really hot rent increase figures year over year. So it's not like not buying a house is protecting you from inflation in housing costs. So we want to talk about what are your options? What are your best moves going forward? But all of this data has to go into making an informed decision for you and your family.
No, absolutely. And that's something we're going to talk about in more detail. Last thing we're going to talk about before we dive into some questions. Many of you know here, if you've been on the show, webinar tomorrow night, 6 p.m. Tomorrow night? Yeah, the 16th. 6 p.m. It's going to be an hour. Help you guys, guide you through the process, if you will. These are some things we're going to talk about. What discussing whether home ownership is right for you. Where do you start the journey? Best way to shop for a home. What's involved in making offers. You're in contract. Now what? And then what happens after the process? So there's a link there. I'll throw a link to register for this if you're interested at all or know somebody that is. Again, it's no cost. It's Josh throwing some good information out there for you. So that is that. Anything else we should throw out before that, Joshua?
No, I think that's a good number.
All right, cool. So I will throw that link in there in just a minute. So let's start. Jonathan had a question here before the show. I was going to address it, but I thought it was a good question to come in with. Looking to purchase in Raleigh. So many of you guys don't know, I'm actually from North Carolina, right? So I actually was just back in Raleigh over the past weekend. I was back home, Eastern North Carolina, east of Raleigh, small town, 20,000 or so people. Inflation's real, guys, out there. Family owns a restaurant. He was telling me that typically he pays around $28, $29 for the bacon that he orders. And I don't know if it's by pound or by box or whatever, but he's $28, $29 for whatever the measurement is that he orders. He's now paying like $85 for that same allotment, if you will, just over the last couple of months. And so that's clearly being passed along to the consumer in some form or fashion. And he did mention that he can't pass it all along because the people there can't support it. So he's actually passing some of it along, but he's eating a lot of the cost as well. So just some food for thought. See how I did that? Anyway,
Jeb, were you going to post the picture that you posted last week of the family homestead?
I will post that on here. I will throw that up here where I grew up. If you guys want to see where Jeb grew up, bet you it won't be what you think it is. So not in need of a home ATM at the moment, but want to buy a bigger home before we get priced out. Should we accept PMI or wait for a higher down payment? We'll be here forever. So the question is, I don't have 20% down to avoid mortgage insurance every month. So should I sack up, just buy the house now, and pay the mortgage insurance, and at some point maybe refinance in the future or pay down that loan and get rid of it, because the other option is waiting until you have that 20% down. But where are home prices then, Josh? So let's talk about it. I just got back from Raleigh. I stayed in Raleigh with some friends the first night I got there. Similar in the fact that there's not a lot of inventory. Demand is very high. Things are moving quickly. So thoughts on that?
Let's look at it this way. Whenever we get should we just accept PMI? Every question that we get about PMI states it as though it's a bad thing. I want to question that. PMI is a gift from God. Absent mortgage insurance, you are not able to buy a home with less than 20% down. So instead of thinking, hey, this is a bad thing, this thing is giving me options. So let's phrase this question as, should I exercise my option to make less than the 20% down and pay mortgage insurance? Well, the first step is, let's quantify it. You guys have heard me say 1,000 times, numbers never lie. So what are the numbers in this case? You are guessing. If you're looking at any of the tools online that estimate mortgage insurance, they're horrifically inaccurate. They're inaccurate for a number of reasons. It's not as easy to quote as interest rates, and generally the interest rates that you see online are a lie. But when you're looking at mortgage insurance, because so many factors go into it, we have a very high estimate in there. I have a system where we go and price out all of our lenders and see what the interest rates look like, and it will give you an estimate of mortgage insurance in there. It is generally about 40 to 50% higher than the actual quote that we get. So in this instance, let's say, Jonathan, if you have 10% down or even 15% down, you're getting close to 20%, and you have a 750 credit score, that mortgage insurance is going to be very small in terms of rate, and depending on the size of your loan, very small in terms of the monthly amount. Let's say your mortgage insurance comes out to $150. It's $1,800 over the course of the year. If you're buying a $300,000 home and it goes up 3% next year, that's $9,000. So they just saved you $7,000 by allowing you to buy without having a 20% down payment. And some of these numbers can be even lower. Mortgage insurance can be as low as like 0.11, 0.12% for the highest of credit scores and the biggest of down payments. It can be as high as 1.75 to 2% for someone with a low down payment and really bad credit score. So you have to talk to a lender and get real numbers before you can even answer this and make an accurate decision and decide. So my advice would be, get with a lender, get the numbers on the table, run an accurate comparison, and decide what you think is going to happen in your market.
Yeah, no, agreed. Great advice. Talk to a realtor. I mean, from what I know about Raleigh, right? Raleigh is one of those areas, because of the Research Triangle and the companies going there. I believe Apple's putting a campus in Raleigh, if I heard correctly while I was there. There is big business coming to Raleigh. Why? Because it's less expensive. It's a kind of a central location in between, the north and the south. The weather's pretty moderate year round. There's, it's growing. It's got the room to grow. There's a lot of people that want to be there for many reasons. Therefore, it's probably going to be one of those places that continue to grow. Now, is it going to grow at 20% year over year? Probably not. But if it's growing faster than you can save money, you're always going to be behind the 8 ball, so to speak. So just take that into account when talking about that. And you got to make sure you got making the right decision for you, right? I mean, if you're comfortable with the payment, you got time on your hands, I don't see why you wouldn't pull the trigger sooner rather than later, because chances are you're going to pay more money in the long run. Let's see. So got a question here. We got Robert coming in basically saying he's got a fever and he's still here. So if Robert is here with a fever,
what's the prescription? What's the prescription? What's the prescription?
I think he probably needs an 805.
It's more cowbell, Jeb. Come on.
More cowbell. Oh, and hey guys, just so you know, I'm not drinking the other stuff tonight. I didn't go, what's the one I normally drink?
Bang.
I didn't go Bang tonight. They're not willing to sponsor me. So maybe Rain will. Hey, I'm looking for a sponsor here, people.
What's the new one that Kassem's always in there drinking? Ghost? Is that what that is? That it seems
I don't
like
know. This is actually his. I took it from
you
him.
stole it.
I
There's
took
like
it.
a new one
No, he
every
gave
3
it to me, but
weeks.
I took it
You
from him.
stole it. You're a thief.
Evan says, was in an IG live with some home inspectors today. Didn't get my question answered, blah, blah, blah. Do some inspectors test soil for lead levels? And if so, when would you recommend one? I'm in New Jersey. So here in Southern California, I'm not aware of any home inspectors that test soil without paying for something additional. Here, most home inspectors just test the property itself. And even then, they're not testing for lead. That would be something completely separate. Anybody testing soil here is like what's their title, Josh? They're a G. It starts with a G.
That's your
I don't
neck of
know.
the woods. I
Anyhow,
don't know all
but
their
they wouldn't be
titles.
testing for that. They would be testing like stability of soil for potential erosion and properties moving and that sort of thing. So testing for lead isn't common here in Huntington or in Southern California, so I can't really address that. Talk to an inspector. If you do find somebody that's willing to do it, chances are it's going to be something outside of the typical scope of the home inspection. It's going to be something additional you pay. I'm guessing on that, but that's just my experience speaking there. And then when would you do it? It would be something you do when you do the home inspection, right? You want to get all of these inspections completed, right? If you plan on doing sewer inspections or, mold inspection or anything like that, you want to do all these inspections, during your inspection due diligence in your contract so that you're not outside of that scope. You can address any, request as part of, the contract that, during your due diligence period. So just, keep that in the forefront. I would talk to some people in your area that buy property, that own property that have bought recently and find out from them if they do any sort of testing on the lead. Typically, it's not a problem after 78. Before 78, it's a problem. I know New Jersey and some of these areas have older homes that were built well before that. So it might be something common in your area. Rihanna Keeves, planning to get a second job to qualify for the house we want. For conventional, how long do I need to work the second job so it can be qualified as a second income for a mortgage? Josh.
So I'll give you the guideline and then the rationale. For any type of loan, it's going to be 2 years. Does it have to be exactly 2 years? You can probably get away with it, maybe around 18 months, but it's going to be close to 2 years to meet the guidelines. And the reason for that is just like this. So let's say you don't qualify. You work 45 hours a week and you make $30 an hour and you need an additional $1,000 a month to qualify for the house that you want. Pretty easy to go out and drive Uber or do any number of things. Uber is probably a bad example because that's 1099 pay, but an employee job, you work, an 8-hour shift on the weekend and pick up that money. The lender's fear is that you're doing that just to qualify, and as soon as you get into the house, you're going to quit, and they qualified you off of an income that no longer exists. So in this context, they're going to want you to have it for 2 years, and definitely at least 18 months before you're going to be able to use it.
Good stuff. Essential man. I'm an uneducated home seller. Ask your questions here. We're happy to address sellers as well as buyers. We can give you some guidance, hopefully.
So I think he's saying is that you only promise to educate the home buyers. He's a home seller.
Yeah, I get it. Unfortunately, our name would be too long otherwise.
The educated home buyer, seller.
Yeah, we could combine the two words and go, the Byler. The home Byler. Anyhow, thoughts on you. This is for you, Josh. I think you just talked to them in some form or fashion. So Dorinda is asking thoughts on using Ribbon Homes to help offer. So Josh is actually part of another group. They did a video recently where they had someone on from Ribbon Homes who kind of talked about their process. What are your thoughts on them?
So in the right situation, in the right state, because I think their footprint is mainly in the South, Georgia, Florida, 5-6 other states down there. I think they're in Texas as well. If they're in your state, they can be really good. The context that Dorinda is asking here, I believe, is as a buyer. As a buyer, how can they help you? Basically, you get pre-approved from a lender that works with Ribbon. It's not Ribbon as the lender, but a lender that is approved with Ribbon. They take that pre-approval letter and they go, cool, we will give you a guarantee letter that goes with your offer, and you don't pay anything if you're able to close on time. But basically what they're doing is guaranteeing the seller is that if anything goes sideways, they're going to come in at the last minute, they will pay cash for the home and buy it. So from that perspective, what can go sideways if you're not able to close with your financing and it gets delayed? If they do that and they have to close with their money, you have 180 days during which you're going to rent the property back from them and you get to buy it, but it becomes a 2 or a 2.5% fee. So the cost of it is fairly minimal relative to the benefit. And I misspoke. I think there's no cost. There's a 1% cost for you to get this guarantee that you would pay them. So where can it be beneficial? You're an FHA buyer and people are saying, I'm going with the cash offer. I'm going with a 40% down offer. You're basically getting a letter that states you will be a cash buyer if anything goes sideways with your loan. So a couple things. You have to work with a lender that is connected with Ribbon, and then you have to work with an agent that understands the program and is someone like Jeb and is able to pick up the phone. Like, you wouldn't just submit your offer with Ribbon, with the Ribbon pre-approval letter and put it in there, because the listing agent likely doesn't have any idea what that means. You would need someone like Jeb to pick up the phone and go, hey, have an offer. It's FHA with a 580 credit score, and that might scare you, but we have a guaranteed approval from Ribbon Homes, who will buy the home with cash on the scheduled close of escrow if anything goes sideways with our loan. So it can be beneficial. Look at it this way, Jeb. Like, what do you think realistically, how much more does that FHA buyer with a 650 credit score have to pay in a competitive market? It's probably more than 1% more than the other offer to convince the seller to go with them. So there could be the benefit. Now, the program that I thought was probably the coolest is they will help people that want to buy a home without selling their home, so that you end up paying that 2 or 2.5% to them, but they're going to buy your new home for you. And now you get to put your home on the market after you've moved into the new home, and you can do whatever spruce ups you want, all those things. So you're not having to sell under duress to whoever is the person most likely to close. You sell at your leisure and can get a maximum price for it. So Jeb, when you're answering the next question, I'll dig in. We did about a 30-minute interview with the guys at Ribbon that I'll post over in the comments.
So I have some questions too, because what happens if you're Ribbon, I'm in contract, you buy the house, and I don't move forward? Now you own a house that maybe you paid a price for it in cash that is too much. Now, what do you do with the home as a Ribbon homeowner?
They, as a Ribbon homeowner, but
I mean, they own the home now, right? I mean,
Ribbon,
right?
Yeah, as Ribbon as the homeowner, that's why they want you to have the relationship. They want to have the relationship with the lender, so they know they trust that pre-approval letter, so that hopefully it's not necessary. But they've built numbers into the equation that they're comfortable with it. You know, their 2.5 margin that they have on that buy while you're selling. But the guy does a really good job of going through all the details. Their website's pretty darn good. You can answer most of your questions there, Dorinda, but I'm going to post over in the comments a link to that interview that we did last week.
Awesome. So Ashley says, can a realtor ask a selling agent what kind of offers they have gotten, so us as buyers can make a decision on whether to even put in an offer or not? Or is that something no one does? No, it's absolutely someone does, and you should do it. Now, here's the thing. All agents aren't going to give you any information. I try to give information without being unethical, so to speak. Now, what does that mean? Well, I mean, if I went out and told everybody's offer, then it's almost like a bidding process. It shouldn't even be, there should just be a site where you see everybody's offers and you can just make the highest offer. Otherwise, it's, it's a difficult kind of line, if you will, right? It's not black and white. There's some gray in it, because there's nothing illegal about me telling you someone else's offer. It's just not the right thing to do in some cases. But I can give you advice and give you guidance and tell you, hey, listen, we've got offers above this, or this is kind of what we're up against. And sometimes I'm honest. Like I said at the beginning of the show, I don't know if you were here, had a property over the weekend, 22 offers, couple $100,000 above the asking price. And I have people calling me saying, hey, well, it was listed at 850, and people are saying, hey, would 950 be a strong offer? No, No, it won't. I mean, I'll be honest, it won't, because these are where the offers are. And the people are like, wow, I'd rather do that, save you some time, quite frankly, save me some time. And, we all move on. Now, in the case where you're getting competitive and whatever, and I have agents reaching out to me going, hey, listen, if you can just tell me the highest offer, I'm willing to come in higher than that, because your job is to get the buyer the seller the most amount of money. And by telling me, I can, decide whether or not, yeah, we could do that game. But let's be honest, it's not fair for anyone else that's willing to put their foot up and make the strong offer to begin with. So you'll have some agents that work with you. You have some agents that won't return your calls at all, won't do anything, and just it's a blind process, right? I mean, when we accepted an offer, I sent an email out to everyone else saying, hey, look, this is what we accepted. These are the offers that we had. We had, you know, 22 offers. 5 of them were above $1 million. 3 of them were above $1,050,000, and laid it out there and said, and the reason I did that is because those buyers that wrote strong offers, $100,000 above the ask, those are good offers, but they should know why they didn't get accepted, because they're going to say, well, my offer was great. I was, cash, and I was putting $100,000 over. That's okay. But I had one that was 200,000 over. So you have to, for me, I like to do that because I want somebody to do that for me and my clients so that we can make better offers. Unfortunately, most people don't. Many, if you ask the right question, sometimes you can get people to do it. But a lot of times in this market, you're dealing with people that, are holding it tight to their chest. And for whatever reason, it's like we're all, competitors against each other versus trying to work together in some form or fashion to, to help everyone out. So to answer your question, yes, you can and you should. It just depends on the agent with how much information you actually get. Clipsum says, with large amounts of equity in homes today, do you think the government will increase property taxes? Surely they have to make money somehow. Where do you see rates by year end? So the government doesn't set property taxes. Each state, each county, the state essentially controls property taxes to some extent, but the county really controls what happens with regards to bonds and different things that are added to taxes, especially here in California, that make up your tax rate. Because California, your tax rate's 1%. But depending on where you live, there might be certain things that are added to your taxes, infrastructure stuff that, bring your tax rate up above that 1% and what have you. So the government as a whole doesn't control it. So that's not, go ahead.
I was going to say, Jeb, look at this. The most important thing is they don't need to raise the rate. The home values have shot up. If taxes, and we talk about Texas, if Texas taxes are 2.5% and home values doubled in the last 10 years, the taxes they collect have also doubled. They don't need to increase the rate. So Jeb's saying they don't have the ability to just jack the rate on you without going to the voters and deciding on that, depending on the state you're in and the state constitutions. But it doesn't matter. Like California, we sit here, our geniuses in Sacramento pat themselves on the back about these giant surpluses. They have giant surpluses because our property values have gone through the roof. And they had giant problems in 2008, 2009, 2010 because property values sunk through the floor. So it depends on where your state is at and how much they depend on property taxes. And you can look up that data. So don't know where you're at. I know you're here every week, but check out how much your state depends on property taxes for the total of their tax receipts every year. But it's highly unlikely that home prices increasing would have any bearing on them choosing to change the tax rate because they're already benefiting from those higher values.
All right, good stuff. I'm just putting this up there because it's a compliment and I like compliments. So, hey, listen, this is the most I've ever grown this out, guys. So we're working. This is a work in progress. Might be gone tomorrow. Might be here in 2 months. I don't know.
I'm just happy that they noticed and pointed out last week that one of us dyes our beard and the other one doesn't.
I almost said something really bad here on camera that I decided not to. Caught myself at the last minute. So yeah, no dye here. This is all natural, people. There's some grays in there. You can see them. They're coming in. Let's see. Jose. Oh, Jose. I don't like this question. I just bought a house in San Diego for $373. Zestimate says $426. You think it will keep going up? And when do you think I should refinance or take money from the equity it's gaining? So for one, don't rely on a Zestimate to find out what your property value is. That's first and foremost. San Diego is a great area. It's probably going to appreciate, whether it's going to keep going up and up and up. Hard to say, but it's always going to be a desirable area. for the most part, depending on where you are in San Diego. But the part I don't like is the idea that just because you gain equity, you need to take cash out. I hate that. I don't like the idea that you've gained equity and there's some reason to pull it out, unless you plan on doing something with it to financially better yourself, right? Maybe it's improving your property, or maybe it's, doing something to invest and make more money, or whatever it is. I don't care for it unless you have a good amount of equity in your property. Now, if you put 50% down and you want to pull a little bit out, okay. But if you put 10% down and it's increased a little bit and you just want to get it out, I don't think that's the right decision. I saw this a lot back in the day. Josh can speak to this as well. Every time somebody gained equity in their property, they refinanced, pulled some cash out, and continued. And when the market did correct, which at some point it will, doesn't mean it's going to correct by 50% or 30%, but at some point it will correct. You don't want to be the person sitting there holding the house that has no equity because you've decided to continue to pull it out time and time again. Josh, you want to add anything to that?
No, same thing. So the refinance has to be logical. So why would we refinance? If you put a smaller down payment, the value goes up, you can get rid of mortgage insurance. But we have to look at the interest rate plus the mortgage insurance has to exceed what current available rates are. Rates have shot up so fast that that's probably not likely that you bought, when rates were lower. So if rates drop in the future, we would want to look at that. But everything Jeb said about taking equity out of the home is correct. It has to make sense. If you can get some equity without monstrously increasing your payment, that might make sense. But you also want to make sure you have a plan for it, and that plan shouldn't be a boat or an Escalade or a trip to Vegas or something like that.
By the way, looked at an Escalade a couple weeks ago.
$114,000.
Oh, you wish. Sticker price on it was $95 MSRP. They wanted $145,000 for the car, bro. $50,000 markup.
So the $1 jillion
mind blown.
Who actually pays it? Or is that their strategy that you think you did good negotiating the $94,000 car down to $120,000?
I mean, maybe. I don't know. Like, I was like, what? Like, what are we talking about here, people? Eventually, cars will correct themselves, guys. I'm telling you right now, that is something that can be fixed sooner. That's not a house. That is something that can be fixed a lot quicker than new construction. So if you're out there looking, just keep that in mind. Let's see here.
Jeb, let me throw one more thing on whoa. This is an important question, but one more thing. This is an important question.
Neither is the answer. Neither.
Bro, you're drinking
soda sucks.
You're drinking Bang.
I know, bro. It's got amino acids. It's got electrolytes. I'm replenishing myself.
It's called super caffeinated soda. So here, the correct answer here is Dr. Pepper. And this is where you Texans have it all over Californians. If you go into the grocery store in Texas, they have 9,000 versions of Dr. Pepper. Caffeine-free, diet caffeine-free, vanilla, cherry, like 9,000 flavors. So they've got it right. Dr. Pepper is the right soda. And
there's not a right.
Mr. Pibb does not hold a candle to Dr. Pepper, but if you challenge me with a blind taste test, I probably couldn't tell the difference.
All right, so guys, we got a lot of questions already. I'm going to skip around a little bit. Some of these questions are asking about buying now versus later and all of that. We've addressed it in some form or fashion, so I'm going to skip around some questions here just to kind of get some of the ones that we maybe don't hear quite as often and help more people out if possible. Maybe a lot of these are comments, so maybe we can still address them. Well, what the hell? I mean, we've got one here. So Homeboy says, late 2020, I made several offers, always in the top 5 out of 40 to 70. I took a break. I feel like I'm a stronger buyer now. Wow. I'm ready to re-enter. Do I start looking with the same strategies, looking in NorCal? I don't know what strategies those are. I would say, sure. I mean, the market late 2020 and now, the differences now is probably stronger than late 2020, quite frankly. I didn't think we could duplicate the spring market of 2021 just because of how competitive it was. And so far, 6 weeks, 7 weeks into 2022, it's looking to be pretty competitive. And it's more because there's even less inventory than there was last year, in a year that we thought, God, there's no inventory. It's even worse this year. I recently did a video and I made I made an incorrect statement that many people wanted to point out to me when I said that there were 2,500
So
properties.
helpful of them.
Yeah, 2,500 properties in Orange County, and 2020 and or 2021, and this year there's 1,200 and something, and I said there's 96% less. Well, what I should have said is this year or year over year, there were 96% more in 2021 than there are now. So there was almost double the amount of property this time last year than there are at the moment. So just less options, as many buyers out there fighting for the same property. So I don't know what your strategies are, but they've got to be pretty ironclad when you're competing in a market with 40 to 70 people. I mean, that's
And
tough.
Jeb, let's just touch for everyone who's asking a version of this question. Everything comes back to supply and demand, and both supply and demand can change. So Jeb is talking about supply is half of what it was last year, roughly, for us in California. Most markets, we look at the numbers in Arizona, Jeb has an awesome report, supply is down. So I would tell you that demand is down, and we talk about willing and able demand. I don't have less people that want to buy a home at 15, 18, 20% higher prices. I have less people who are able to buy a home. So you would be fools to say we have the same demand as we had last year. Last year's able demand of people who could buy these homes, but there is still plenty, like a surprising amount. Jeb was surprised by his listing in Irvine and the number of offers they got.
Yeah, let's talk about. I mean, I don't want to hammer this down because it is. It's like the beating the dead horse thing, but 22 offers. So that was an 850 purchase price. Every offer was above the purchase price. Okay. And so they ranged anywhere from like 875,000 or so to over $1,050,000. So a big spread there, right? A big spread. Now, how many of those were cash? I think 3-4 of them were cash. How many of them waived the appraisal contingency? A good percentage, at least 50%, maybe more. I'm going to do a video where I break this one down in detail so you can see exactly what people offered to give you an idea. But the reason I'm bringing this up is because there are 22 other people out there just on this one property willing to do crazy things to get in. And so it's not just one person making higher offers or one person coming in with cash. There's multiple people out there willing to do that. And so that is what your competition is. The question is, how do you stand out in this type of environment? It's not just one thing you can do. Cash doesn't win it, right? There were 3 cash offers at least on this property. I don't know the exact number, but cash didn't win it. What won it was not only the highest offer, but the strongest with regards to down payment, with terms, with contingencies, with all of it. Was a multiple factor thing. So if you're making offers out there, you've got to really have it all. And there was an FHA offer, and I felt bad. I'm like, and the FHA offer was nearly $100,000 more than the asking price. But guess what? They didn't have a chance because of everything else. So just shows you what's going on in the environment at the moment. I mean, and we're talking rates this past weekend, 4%, right? So we've risen to that 4% level, and demand is still out there. And a lot of these people, again, were getting loans. So.
And I think, Jeb, let's go back to the chart of the 10-year Treasury. We're saying inflation figures come out last week at 7.5. The 10-year Treasury, which looks forward and collecting interest over the next 10 years, is at 2.02%. You go, well, why is that? Well, buyers are saying the same thing. They're saying, I don't believe rates are going to stay this high going forward. So I will buy in at 4 and set my worst case at 4% and be okay with that. And most likely, I'm going to have the opportunity to refinance at some point in the future. It might be 1 year, it might be 3 years, it might be 5 years. I talked to a fellow loan officer this last week, and he was moaning about not having any refinances available because he didn't build his business around purchases the way he should have. But he was saying, well, I talked to such and such expert, and they think we'll have refis back at the end of the year. I go, it's pretty foolish to think that we're going to have them change that quickly. I can't think of any case of why rates would be dropping so low that anyone other than the people buying right now at 4% would have a refinance opportunity. But most consumers are saying, I'm okay with 4%. In the grand scheme of things, that's not horrible. And I think I'm going to have an opportunity to refinance at some point in the future to something a little bit better.
No, good stuff. I saw this question pop up. It's a pretty easy one to answer, so I'm gonna throw it up there. Digital Ken's asking, what are probate properties and where do we search those probate properties? So probate property is when someone passes away that doesn't have a will, a trust, any final decision in writing with regards to where that property goes. It goes to the court. The court sells it, if you will. Well, they're not all court appointed sales, but essentially someone that's passed away without a last will and testament, if you will. And so it has to be sold in probate, which means that typically a court is involved in some form or fashion. Now, where do you find those properties? They're on the MLS, typically like any other property. They get listed just like any other property. Like when I list a property on the MLS, I have a couple of different options as to the type of property. A standard sale is like any other sale, right? It's a normal sale. I have the option for a probate sale. I have the option for real estate owned and REO. That typically means a foreclosure. I have an option for a short sale, which means somebody's selling it for less money than they owe on the property. So we have options. And so you typically should see in there if it is probate just based on that type of listing. So hopefully that's helpful for you. I saw this question. Josh, you and I kind of talked about this the other day in some form or fashion. With inflation out of control, people are running out of money. So they got to refi and take money out of their house to pay for stuff. So my question to you, Josh, is let me say something first. So the average homeowner at the moment has $185,000 of tappable equity. Okay, so let that sink in. Tappable equity is above and beyond the 20% down that you have to have in your property that the lender requires. So you can't
taking out up
right,
to 80%, not
right,
total equity.
Exactly. So you can't typically refinance and pull cash out more than 80% of the value of your home, unless it's a VA loan, in which case it's a little different scenario. So you got to have at least 20%. So the average homeowner has that 20% plus an additional $185,000, $9.9 trillion in the system, guys. A lot of money out there. So Josh, you deal with loans? Are you seeing people refinance? When they're refinancing, what are they pulling that cash out for? Now, they don't have to be honest with you, so to speak, but are they paying off debt? Are they buying cars? Are they doing home improvements? What are we seeing?
The two most common, and I would say it's probably far and away number one, is I'm buying more real estate. I'm pulling some equity to buy another property. They're not burning it. And a lot of our clients, think about this. I have a lot of clients that could not buy a house today, but they were smart enough that 5 years ago they bought some areas of LA, they bought for $325,000. And it was probably a dated, aged home that needed a bunch of work. And today the home's worth $775,000. So they pull $75,000 or $80,000. It gets a new kitchen, might get a master bedroom addition off the back. It goes from a 1940s 1,000 square foot house to a 1,500 square foot house, and now it's going to be worth another 100 grand. So those are the two most common. We get a very little bit of debt consolidation. And think about this. Part of this is the bias of us being in California. If you refinanced during the last few years and you have a 2.75 or even a 3.125 interest rate on a $4 or $5 or $600,000 loan, and you need $50,000 or $60,000 to consolidate debt, you're not taking out a new mortgage. You're not giving up 275 to go to 4.25 to get $50,000 or $60,000. So for the most part, those don't exist. Now, do I have people asking about it? Yeah, but they're generally looking and saying, okay, well, show me what a home equity loan looks like. And there's some of that, but it's very, very, very minor. The conversation you and I had was, do you remember? So the last time we had a crazy market, you were doing loans, you weren't selling real estate. And in 2005, 2006, 2007, I say from 2003 to 2007, I had 20 to 30 clients who refinanced cash out 3 to 4 times. Like coming back like every 6 months, we need more money. I'm like, what in God's name are you doing with this money? We don't have any of those people now. None, zero. Wow. So anyone sitting there thinking, oh, those people are crazy, and we see this mortgage equity withdrawals at the highest levels since 2005, 2006, whatever the number is, they are higher. but it's going to productive uses. I don't have anyone pulling money out of their house to burn it in a stack, because most of those people can't qualify. Either they've got an income problem, so you can't get them a loan. Think about that. Back then, you could lose your job and do a stated income loan. Say, I am a home-based bookkeeper and I make 12 grand a month. You can't do that anymore. You have to qualify for the loan. So if you've had financial trouble, you missed some payments, your credit scores suck, you're not going to get that cash out loan. So it's a
No.
myth that there's some crazy loans out there that are adding risk into the system. And that's why, Jeb, you've got people with the average loan to value in the country is under 50%, and with people with 180,000 average tappable equity with a median home value of under $400,000.
No, and the reason you and I actually were having the conversation is we were talking about inflation at the time, and the conversation was, hey, can inflation continue at this rate? And you and I were going back and forth, and it was like the majority of the stimulus money has been spent at this point. Any child advanced child credits have likely come to the market, and many have been spent. So the idea that people can continue to spend money on frivolous things at the rate that we've seen is probably not likely, right? And so my question to you was, okay, is it possible that some of these people pulled some cash out, it's sitting on the sidelines, and they're going to continue to be able to feed their lifestyle by that cash they pulled out? And I think the easy answer is there's a possibility that happens, but or I don't know, Josh. I mean, what are your thoughts on that real quick? I mean,
again, we did $118 million of loans last year and $100-something million the year before that. So in almost $225 million of loans, probably about 60% refinance in that. I can count on one hand the people that took more than $15,000 or $20,000 out for debt consolidation. So that I got too much debt, I'm going to pay the debt down. Nearly everyone was, my home has gone up in value. I don't want to, can't afford to move. I want to make my house nice. Or, hey, my house has gone up in value. This was pretty awesome. Let me get some cash and go do it again. That is, and I'm not saying that I'm the only loan officer in the world, and we do kind of attract people that are similar to us. So that probably means that my borrowers are the smartest ones out there. But just saying, like, I don't think other people's clients are all that different from mine, and that they're out there just using their home like an ATM. For the most part, people learn their lesson. When I say for the most part, like to 98% of people learn the lesson of the last downturn.
Good stuff. Julie Rocky, any new guidelines for conventional loans at all, Josh?
Not really. The only update we've seen that's significant this year is removal of some of the COVID overlays for self-employed borrowers, which didn't really improve anything for self-employed borrowers. It just took them back to what it was like before the downturn. And Jeb, if you don't mind, let's go back to the inflation question. There's something that you said that I kind of want to put into context. Let's go back to the beginning of 2020. For several months, we literally had negative inflation numbers. So when we look at those things year over year, last year they were really hot. So we've talked about in 2020, why did we have deflationary figures? Because no one was buying anything. So people wanting to sell it had to put it on sale for the most part, right? And at that time, the government is pumping money into households. You can't go out. You're locked at home. You can't spend money. You can't go on vacation. You can't go to the bar. You can't go to the hotel. You can't go to the restaurant. So last year, things opened up, less restrictions, and all that money sitting on the sidelines. So we had artificially low inflation figures
For
in
sure.
2000.
Yep.
And then we have artificially high figures. And the way we measure is year over year. This isn't a mystery. Like, people think something happened. We have several comments over here. I'm not going to dignify them by putting them up here like, you guys are nuts. Inflation's going to the moon. Cool. Tell me why. Tell me the mechanism. Tell me what changed from the last 15 years where the Fed couldn't manipulate inflation for a sustained period over 2% to now we can't control it. It's just completely out of control. I can tell you one and only one thing that has changed is that the supply chain issues that we experienced over the last 2 years, there are global economies that are looking and going, can we pull some of our production back from China so that we're not as exposed to those far-flung supply chains? And China makes things cheaper than anyone else does. That would be inflationary. You cannot tell me any other factor that is changing long-term that will be inflationary. Every other trend, aging populations, technology, government debt, all of those things are deflationary. So I'm not saying we're going to have deflation and lower rates tomorrow, but it's coming. 2 years, 3 years, 5 years, we will have lower treasury yields and lower mortgage rates than what we saw at the last downturn. And that's because there are no inflationary forces building, and you can explain everything that happened pretty easily over the last 2 years.
Good stuff. So 371 people on here. That's our highest number ever, guys. So thank you for being here. We're here to address real estate mortgage questions. If you have them, put them in the description or in the comment section, rather. I'm going to ask a favor. Hit the thumbs up if you're finding any value at all. I don't like to ask for things, but I do appreciate you guys being here, and it's a way to get more people out there and see it. So thank you for that. So let's go here. I saw a question I wanted to get to. So Andy Luis, a first-time home buyer using FHA, has been outbid a couple times, asking for tips, asking about love letters. So FHA loans right now in all markets, probably not quite as crazy here in Southern California, right? Multiple offers. Like I mentioned, 22 offers on a property. One of them was FHA. Everybody else had at least 10% down. The majority of people had at least 20% down. So that's what you're competing against. How can you compete? It's tough. I mean, I can't say that there's, a steadfast, easy way to get your offer accepted. It's not going to be. A lot of it has to do with relationships, agents knowing each other, having that relationship. That's going to help you. Writing a strong offer, being able to waive certain contingencies, maybe even using escalation clauses and that sort of thing in your contract. But even with FHA, it's tough because you don't have the down payment. So you need an agent that can convey to the other agent that you are well qualified. You need a lender that can help you with that. But honestly, there's no advice I can give you here that you could use tomorrow that's going to just make sure. You've got to do it all. You've got to make, all of the things to help you, right? I put an offer in for a buyer here that actually came from the channel, I believe. And we were buying a property in Orange, where they're looking to buy a property in Orange. And the offer price on that property was $585. We made an offer at $600,000. I told them, based on our conversation, that I thought it would go over 600. Didn't really know where it would go. They had 10 offers and it sold for 640. So these clients are putting 10% down. 10% is a decent amount of money, but when you're competing against 9 other people and somebody's willing to go $40,000 higher than you, hard to compete. Even if we did write a solid offer. I mean, we wrote a great offer, but we still didn't have, much leg to stand on. And so it's tough. But you ask about buyer letters. Many agents in this market are putting in the comments not to submit a buyer letter. My clients we won't review it. Don't submit them, blah, blah, blah. So what we were once using to help, clients stand out, many agents now aren't allowing them. It's worth submitting something if they're allowing it, but don't think that buyer letter is just going to get you, your offer accepted, right? Many people out there want to sell their property to a nice family because they grew up and it was a family-oriented environment. They raised their kids there, so they want somebody else to be able to do the same. So if you can tie into that emotion, great, but it's just a tool, right? It is not going to make, the entire offer get accepted. You got to couple that with everything else in order to be able to, compete, Jeb, if you will. Yep.
Let me throw out there. So when in my flipping days, we sold over 40 homes, meaning I wasn't the realtor. We sold over 40 homes. I'm the seller. And nearly everyone, because the market was down, but there was a lot of distress and ugly property. We were fully renovating all of these. Ours were beautiful. So we would get people multiple offers. And it is great to know that it's a family and why they love the neighborhood, why they love that house. What's not fun is when you get 3 awesome letters from a wonderful family, 3 wonderful families, and you have to know that you're telling 2 of them no. When it's just Joe Smith, Valerie, and Pedro, like that's just 3 people. Like, I don't know who they are. I don't know their story. I'm going to make the best decision for me. Now imagine in this market, they probably don't have 3 of them. They've got 20 of them. And you got to realize 19 families are going to be hurt and disappointed by that. So it's not even that they don't care or they're heartless. It's just, if you're a caring person, it makes it even harder to go through that. And Jeb, another thing I wanted to kind of piggyback off of that, we have a buyer right now, and I think he may have come from the show. FHA, due to a credit issue, has to go FHA. No other option, even though they have a nice down payment. He says, no, I don't need a realtor connection. I've got a good realtor. She calls, and I think she's done 1 or 2 sales before. And she proceeds to tell us what kind of loan can they do besides FHA. You can't get an FHA offer accepted in my market. So we tell you guys every week, I don't ever want to hear another buyer, seller, or realtor say the words in my market. If you are in the United States of America, you are in a crazy market, and it is hard. And I can tell you, we have FHA buyers every week get their offers accepted. And the common denominator in the ones that have to make 20 offers versus the ones that have to make 5 or 6 offers are the quality of the agent that they're working with and their ability to communicate, negotiate, and the quality of their network. Billy put one under contract today. The strength of his network. It's an agent that he knew that we were able to go, what number? That agent knows me as a loan officer, the agent knows Billy as an agent, and we were able to come to a number that made their sellers happy and convince them that they know the people in the transactions are going to go well. So that agent that's done 2 deals, she's never going to be able to have a relationship with someone unless she magically knows the seller, because she doesn't have a big network of realtors. So a lot of it is just the attitude and the mindset. Jeb, if you send me someone and I get them pre-approved and I say, hey, good news, they're pre-approved, but they can only go FHA, are you going to turn around and go, we might as well not even try if they have to go FHA?
No, absolutely not. I mean, we're gonna do our best. It's gonna be tough. It's not gonna be easy. And that's okay. I mean, that's a conversation we're having. But yeah, you want an agent that's gonna try to get it done.
And same thing with VA, Jeb. We get this all the time. We'll have a wonderful VA bar. Hey, well, how much can they put down? We need to do a 5% down conventional. I'm like, are you nuts? Do you think that someone cares between a 5% conventional and a VA? But we have agents all the time. They're like, you got to be crazy. We had someone show up last week that said they got their offer accepted VA because it was a veteran seller. I would say It's more often that someone with a VA gets their offer accepted in a sea of better down payment offers versus a 5% or a 3% or even a 10% conventional. So don't let anyone tell you it can't be done. Work with people to have a positive mindset. Have a positive mindset yourself. And exactly like Jeb said, no, it's going to be difficult. It's not going to be easy, but nothing worth doing ever is.
Good advice. We should just end it right there.
End it. Mic drop.
So this is a good question. I think this is something a lot of people want to know. More than 50% of Americans don't have $1,000 in the bank. Where is all this cash coming from? So let's think about this for a minute. You have home buyers that own a house, right? They're move-up buyers, if you will. Over the last 2 years alone, just 2 years, they've gained 30% equity in their property, give or take. As I mentioned earlier, the average homeowner has $185,000 of tappable equity. So these move-up buyers have cash because their properties have gained appreciation. So that's cash you're competing against. Move down buyers. These are boomers. These are people that no longer need the bigger property. They want something smaller. They're going to sell the bigger property. Guess what? They've owned their properties for a long time, many of them. They have cash. You also have investors, right? Those people are looking to invest in property. Maybe they're looking to maybe they have RSUs because they have stock with the company and it's seasoned and they want to take it out of the equity market and put it into real estate. We have a client like that at the moment. He's got cash. He's done well financially, so he's looking to invest in real estate because he knows what real estate's going to do long term. Pension funds, hedge funds, big companies out there that are looking to buy property, rent it out. These guys have cash. Zillow's out of the market, but guess what? Nobody else is. Everybody else is buying property. And then let's talk about first-time home buyers, because everybody says, well, first-time home buyers don't have any money. Some don't, but many are getting gifts from parents early. Many are getting gifts from grandparents that are going to eventually, there's a trust. There's something that they were going to leave them money when they passed away. And they said, you know what? I'd rather see my kids enjoy it. I'd rather see my grandkids enjoy it now. By buying a property, I'm going to take this money out and give them a gift. And the reason I can say this is because I see it personally with clients, people that are getting money from these different places. So you've got a lot of cash out there. And that doesn't take into consideration the people that have just saved it, right? They've done well financially, their jobs, they've put money aside. And so you've got all of these people that you're competing against. It's not, the person that you're talking about that doesn't have the $1,000 in the bank, they're not home buyers. That's not your competition. Your competition are the people a good majority of them are people that already own real estate in some form or fashion. That's what your competition is. So, Josh, anything you want to add on that one?
No, really. This comes back. We've hit on it before. We're not going to go down that rabbit hole tonight, but there is a problem with inequality in the United States of America, and we have two different Americas. The 50% of the people who do have assets and can buy houses, and they have food security, shelter security, and then you have the other half. And at a certain point, it will become a bigger problem than it is today. But for right now, that 50% that have assets have more than enough to make this happen in the current market.
All right. Pogimoto's asking, what's a Hubbard clause? So I wasn't familiar with it, but I just Googled it real quick. It's basically, it's a contingency. So it means basically that the seller has a property to sell in order to buy. That's what a Hubbard clause is. We talk about contingencies all the time. You know, sometimes sellers have contingencies on finding a replacement property in order to be able to sell their property. Well, it sounds like the buyer, if they have a property to sell in order to buy, that's what the Hubbard clause is. So hopefully that's helpful for you.
Hey, Jeb, we got a good one here that we skipped over earlier. Gondon21 says, I'm ready to close, did my final inspection. They agreed to do all repairs, but they didn't use a licensed contractor. Some of the work is not done properly. What can I do?
Ooh, you can go back. I mean, it's, you know, you're doing a final walkthrough, I assume. You have the ability to go back and have it done correctly or not close, or ask for a credit to do it correctly. I mean, at the end of the day, you don't have to close on the property if you're not happy with the repairs that were done. You shouldn't have to state in a repair request that a licensed contractor do the work. At the end of the day, I don't know if you care if a licensed contractor did it or not, as long as the work was done in a workman, you know, a quality manner. And so it's a tough one to navigate, but I mean, you need to have agents. I mean, that's why you have an agent. Like, your agent needs to have that conversation with the agent on the other side saying, hey, listen, you know, we walked through, the repairs were done, but they're not done correctly. And so we're not closing until they are done correctly, and or you give us a credit. Now, this isn't advice, right? You're in contract. I can't give you advice, but it's, as a friend, this is what I'm, you know, the conversation that I would have. Outside of that, you don't really have a leg to stand on. I mean, you could close on it, but if you close on it, the chances of you getting anything done are probably nil. You know, you're not going to have somebody do repairs after the fact, and it's tough to get them done. So I think at this point, you're probably better off trying to get a credit to do the work yourself versus holding up the close and allowing them to do it again. That's honestly, as an agent that negotiates repairs all the time, I'm always trying to get credits, either from the buyer side and or the seller side. If I'm representing the seller and you want me to do a bunch of repairs, no, we're going credit. Because why? For one, you know, in your head, those, you know, those repairs may or may not, you know, in your head, that the cost might be different than the credit that we're going to give you. So I might give you a credit that seems way higher than the cost of those repairs might be. And so that's an advantage for me to negotiate on one side. But more importantly, I don't have to deal with work. I don't want you coming back doing this, saying, well, I don't like that, they didn't do it right, or whatever, right? If I just give you a credit, it's on you. You take the property, we all move on. Same thing for a buyer. I want my buyer to be able to ask for the credit, and then they do the work on their own, because guess what? They can go out and find the contractors they want, negotiate prices, and maybe get it done for less than it would be otherwise. So that's the easiest route. But in this case, I think you gotta have that conversation.
Jeb, I almost skipped over another good one up here.
All right.
Toom or 2M says, I own a 1,000 square foot condo in Tampa that has appreciated 100% in price, so it's doubled. Do you think there's a glass ceiling for condos particularly? I mean, just how much could a condo be worth? So, Jeb, we talk every week here, supply and demand. Largely, the number one factor, and probably the number 1 through 5, is simply supply and demand, and it's absolutely a factor here. But another economic concept is the principle of substitution. If steak goes to $400 a pound, most people are going to stop eating steak and they're going to look at chicken or fish. So what's a condo? Home prices get too expensive and people go, well, cool, I can buy a condo.
Yes.
if condos get too expensive, they can rent or they can buy a single family. Well, single family is even more expensive. And then we go back to the supply and demand coming into play there. But you just have to look. There's nothing intrinsic about a condo that says it can't go higher in value as long as rents keep going higher, single family homes go higher, and there's still enough able demand of home buyers to push the prices higher.
I mean, I can't add anything onto that. I mean, you nailed it. That's exactly it. So the easy answer is, can it go higher? 1000% it can go higher.
That's not to say it will.
Yeah,
It's saying
that
it
doesn't mean
can't.
it will, but there is, I mean, again, I've never, the principle of substitution is what I wouldn't have used that, that phrase, if you will, but that's the best way. I mean, yes, people are now looking at condos because of the cost to own a single family. So it is the option to get into something that you own, get the benefit, of owning something, and then, and reap the rewards of that appreciation, hopefully. Right. I mean, I told my wife a couple of years ago, the property that we own, I said, I told her, I said, hey, look, this is going to be a $1.5 million property at some point. Right. And so, and she's, yeah. And then, hell, I mean, at this point, because of how fastly things have gone, it's going there a lot quicker than I thought it would. But it's just because of where we are, location to the beach, lack of inventory, lack of, take the inventory out of the equation, just location to the beach. The fact that you can't really build in Southern California is more of what I meant. The amenities, all of that is what's going to continue to drive up the prices long term. It happened a lot sooner than I thought it would. But the easy answer is yes, it can definitely go up.
Jeb, when you were saying that, you used the example of your home, it made me think of your listing in Irvine. If you had told me that place was going to sell, a condo in Irvine was going to sell for that condo in Irvine was going to sell for 1.1 million, I said, yeah, I can believe it. So what, like 20 years from now? 20 years from when they bought? It will get there eventually, but in 2 years, 3 years, that's a crazy number. So don't sit here and say these things can't happen, because they do. And they do because what's the alternative? If you want to live in Irvine, what are your other options? You don't have many.
All right, there you go.
Can we continue with the economics portion of the show? Chris Carcito says, I always operated on the assumption that as interest rates rise, the price of housing should decline. Rates are definitely on the rise, yet I still see housing prices increase. Chris actually almost answered his own question here. A few people chimed in, but the answer is it comes down to supply and demand. Home prices are still going up because despite higher interest rates, there are still enough people who can afford to purchase and want to purchase that it's pushing home prices higher due to the low supply. But if you want to look back historically during times of inflation and higher interest rates, home prices have gone up. I question that going forward. I do think that there will at some point, if rates were to continue going higher, which you've heard me say I don't believe they will, but if they did, I do believe there will at some point be an inverse correlation that higher rates would lead to lower prices. We're just seeing right now that it's nowhere near where we're at now in terms of supply and demand.
Good stuff. So, I mean, I think something we should address here really quick is that Joey cracks a homeowner.
What?
Nice, Joey. Finally, 10 months. 10 months he's been a member of the channel here. So he became a member 10 months ago. I have a thing here. So I don't know where that message went because I see it on one screen, but not on the other. But more importantly, congratulations, dude. That's awesome.
Congratulations, bro. And it's been
that must mean we've reached the top of the market, though, Josh.
It must be. He's the last one in. Last one in. Turn out the lights. He's the guy.
Too good. No, congrats, man. That's awesome. Good stuff. Let's see. See anything you want to add on there? I'm looking at some questions. Do y'all have any contacts in Texas looking to get a property by November? The answer is yes. It depends on where you're looking. I know agents all across Texas. In fact, I know quite a few in most of the major markets. So if you need an agent, reach out. If you need a lender, we have great lender there as well. A couple of great lenders, in fact. We can connect you. So I'll throw a link up here on the channel if you want to go across the bottom there. Click that up. You can be anywhere in the United States, get connected with a real estate agent, with a mortgage professional. Many of you guys have done that and had really good success and reached out and thanked me and Josh and all of that. So use
What
that
about
and get connected. Yep.
what about territories like Guam? Do we have a contact in Guam for them?
I have a huge network, and
so,
I mean, I
so
do.
the answer is yes.
I don't know. I mean, I have a huge network across the United States in most of these markets, and I'm assuming if I asked in some of these channels I'm part of, if we have somebody in Guam, there is going to be someone there. So I would say yes, but I can't say 100% because sometimes you get these little small markets where there is no one, and so then I'm left holding the little thing that says I'm sorry. So
Jeb, how did we miss the super chat?
we did. Let's
Yeah.
see. We're up. Oh, Ricardo Rivera. Thank you, sir. There's still deals out there. Have a probate under contract with over $60,000 in equity as is and closing on February 28th with over $50,000 in equity as is. So congrats. That's awesome. So that's probably why the probate question came up earlier is how do you find probate? So that's what a probate is. Sometimes these families are just looking to get rid of the property because the family owns it. They don't want to deal with the property. Who cares? We're splitting it between 10 kids. Who cares if it's $60,000? That's $6,000 each. Not a big deal.
So
Making an example there, but there are opportunities in some of these cases. Yep.
Jeb, I should have followed up earlier when the person asked. So you're talking about how do I find out in the MLS? Here it's tagged as a probate.
Right.
You can if a property has to go through probate, it means they didn't die as joint tenants. So Jeb and I own a property together as joint tenants. I died. Jeb just owns the house. There's no probate. If we have it in trust, it goes to whoever gets it in the trust. Probate means that there's a court filing, and most everywhere in the United States, you can get a list of probate properties and you can reach out directly. Just know there's competition there as well. There's people just like Ricardo that are contacting those people and offering to buy the property.
Yep. And many times the attorneys are these go to an attorney, the family gets an attorney involved or whatever, and there's a relationship there with the attorney. And so it's just like anything, it's a lot of who you know. JR is asking, love the show. I'd love to sell my house next to Dodger Stadium. Can you recommend a real estate agent? Again, that link there scrolling can get you connected. I know a lot of good agents up in LA, so happy to connect you there. Jonathan, do you think new homes built these days will most likely have massive quality issues since builders are starving for laborers? Better to buy older houses right now? I don't necessarily think so, right? I mean, everything goes through an inspection. The builder, the county inspectors there inspecting these properties. So that, I will say overall, the homes that were built probably back in the 40s and 50s are, the fact that they've stood the test of time and still here 70, 80 years later is a testament to the quality of some of this construction back then versus now. But now there's different standards. Like here in California, there's standards for earthquakes, there's different things that have been retrofitted over time to make the quality of building better. So I don't think the laborers are going to make less, quality houses. What you have to worry about the laborers is the time that it takes to build some of these houses, right? If you can't get quality laborers, then you can't build houses at the rate that you need to be able to supply some of this stuff. So, while you see, housing permits are up or housing starts are up, great, congratulations. There's new houses going to be built, or we've got the permits. Well, great. Now let's go find the workers to do it and find the materials that you need to build these houses. It's a little more difficult than the media wants to make it to build some of these properties. And that's why I don't think that's not a short-term solution. It's a great solution long-term, but it's not a solution that's going to have any impact in the foreseeable future, in my opinion. Now, Josh, thoughts on that? There's some bigger names associated with the building that think that inventory is going to change.
It's regional. We talk about it's not
Right.
it's not monolithic. The U.S. market is not one market. And when Ivy Zellman's out there saying, "Hey, it's going to be a problem," they're overbuilding in certain areas. She knows the market really well. She's a smart lady, and this doesn't guarantee that she's right. But I find it hard to believe that she is universally wrong across all 50 states. She's going to be right in regions of the country. So you need to look around and see how many homes are being built in your area. If there's a lot of them, it could be an issue.
All right. Easy one here. Is waiving an inspection a good idea to win an offer? No. I don't recommend waiving an inspection. I think that's the one contingency you do keep, unless they're providing you a home inspection that you trust or can have a conversation with the inspector that, that did the inspection to ask any questions, that sort of thing. It's
Jeb,
a tough one.
if I'm not waiving my right to have an inspection, I'm waiving my contingency based off of my inspection, correct?
Well, here's the thing: is some agents will be sticklers for that, right? So if you're waiving the inspection or you're not putting an inspection on the contract at all, right, you lose that due diligence period for inspections. And so some agents can be, Richards about it and say, hey, listen, you didn't put an inspection on here, therefore we're not allowing you to have one. I mean, that's the reality. Now, I would say you'd have to be a real Richard to do that. You like that? I saw a hat one time that said, "Don't be a Richard," and I was like, "That's a fantastic hat." And then she was like, "It's
30 minutes later, you figured it out and chuckled to yourself."
It sucks anytime she's like, every time I meet a guy named Richard, they're like, I hate that hat. But anyway, yeah, it would take a real dick to say, no, we're not going to allow you an inspection. So just know by waiving that, you're really opening yourself up to a possibility of some bigger issues that might not be known, might not even be known to the seller. So the fact that they can't even disclose it if they, because they don't know about it. And so you could really be putting yourself in a difficult spot.
Jeb, my background is largely as an investor and having bought a lot of homes. So I look at it a little bit differently. Not in any way that you're wrong, but you're thinking for my buyers, I want to be able to go back and negotiate if something comes on that. If I'm serious and I want to buy and I've walked through and done a visual inspection, I'm comfortable saying I'm waiving my inspection contingency. And if they pushed back and said, no, you can't even have an inspection, I say, listen, bro, I told you I'm okay with the condition. We're buying it as is. I'm not asking you for any repairs, but there's no world in which I'm buying your house without an inspection to just confirm there's nothing major there that it would force me to not want to buy the home because there's a $150,000 foundation repair. It's a different approach, but for me, I would have a hard time ever learning something on the inspection, assuring them that I would never ask them for repairs and then going and asking for repairs. And for the most part, your position is we want to ask for repairs, even if they say it's as is and we're not going to, right?
Yeah, no, absolutely. Agreed. So, but just know when you go into it that, it might not be as easy as just waiving it or not waiving it, but have a conversation with the agent. I mean, if you want to buy it as is, that's something you can state and still get an inspection, right? I mean, and that way you're kind of letting them know, hey, listen, we're willing to buy it as is. We still want an inspection. And then it's laid out pretty easily. Michelle's asking, is there a lender that specializes in FHA with the knowledge of regarding cash out refi rules? So,
I know one of those guys.
Well, yes. I mean, there's any lender that does loans should be able to guide you. Well, no, not any lender that does
my
loans.
Friend.
An expert in their field should be able to guide you through that process, whether it's FHA, conventional, VA, what have you. Not everybody out there is an expert, right? So that is part of the problem. So just make sure you're getting connected with the right people. But the people out there that have experience should be able to have that conversation. Again, I didn't realize that link's still scrolling across the bottom.
People at that referral link, would they know how to regard?
Yeah, so that referral link there at the bottom can get you connected with the right people. I didn't realize that was still scrolling. I'm going to hit that off here.
You know what, Jeb? I just noticed something. So Ricardo's super chat was the only super chat tonight, and I've noticed that the super chats have decreased since I started mentioning that you've never shared the 805 money. So maybe I should tell them that you do actually share the 805 money so that you could get some.
I'm not drinking, bro. I'm growing a beard. I'm
just telling you why they're not giving you
any super chat money is going to go to beard products to make this more. It's like a broom. Somebody said it a couple weeks ago. It really is. It's like bristly. It's going to go to products. It's going to make this thing soft. I'm going to be like Santa Claus. You guys like that, right?
You're getting there. So you're gonna have to stop dyeing it though if you want it to get like Santa Claus.
We're gonna have a Yellowstone party here on the channel, and everybody's gonna have to wear cowboy hats and grow beards.
Okay, we'll convert.
There's only two of us.
The bunkhouse. Gotcha. So, hey, Jim, we got another easy loan question here. Alfredo's in Dejas is going to be eligible for his VA loan soon, but what is better to use for my first home purchase, the VA loan or first-time homebuyer loan? I'm sure you never speak in absolutes because someone will come up with an instance where they can tell you that is not true. in nearly every instance, if you are eligible for the VA loan, it is the best way for you to get into a home. Extremely low interest rate. Lender or seller can cover all of your closing costs. No down payment required. If you make a down payment, you can lower your VA funding fee. But talk to an expert lender, have them show you the side-by-side comparisons of first-time buyer programs available in your area. And sort of on a side note, people always ask, well, I'm a first-time buyer, what special programs are available for me? For the most part, there aren't. Very few programs are limited to first-time buyers, and those that are don't generally have huge benefits to the buyer. But ask and have your lender go through what may be available in your area. There are some state and government and locality-based programs that do exist, so definitely ask the question.
All right. This is a common question we get, but it's worth addressing because I know a lot of people have it. What are your thoughts on client pulling money out of their 401k for a down payment, Josh?
Yeah, it does come up a lot. I don't have a problem with it. You can get up to $50,000 or 50% of your balance out of your 401k to buy a home. When we talk about that, there's multiple ways of getting your money. You can just cash in your 401k.
Not a good idea.
If you're not of retirement age, you're going to pay a penalty. You're going to pay taxes, and as Jeb said, a terrible idea. But if we're talking about accessing your funds in your 401k to get you into a home sooner than you saving up the money, I don't have any problem with it. You're going to pay yourself back with interest, so you're not eating your 401k. It's still there getting a return for you and getting you into a home to put shelter over your head, fix your housing costs, and help you start building equity. So zero problems whatsoever with anyone using a 401k to access funds for their down payment and closing costs.
All right. So Kim, I really was about to insult Kim, young Kim. I almost said Kim Jong-un when I said that. I just saw the two and sorry. Must work at Google, maybe. Hey, anyhow.
Or super fan, Google super fan.
There we go. Can you comment on inflation adjusted home prices from 2008 and what the value is year to date? I know when I did this analysis, we observed that homes did not go up in value inflation adjusted. So I actually don't know. I'm sure the Fred has a chart out there, Josh, that
I'm digging.
pull up. So we will get to this question in a second. I don't know the actual number off the top of my head. I'm assuming there's some inflation. I mean, again, inflation was only 2% year over year for the last 15 years or so. I mean, we couldn't even reach 2% most of those years with regards to inflation. Now, over the last year and a half, we've, exceeded that by quite a bit, but I don't know what the actual numbers are here.
I'm not seeing it on Fred. And here, it's a false premise saying that if home prices don't go up adjusted for inflation, which I would have a very hard time with that, because if we go back to 2008, we're up 100%. 80%, and inflation, using the rule of 72, we haven't come close to that. But more importantly, spreadsheet jockeys love to go through and talk about how, well, home values go up on average 3%. The stock market goes up 7%. The most important thing to realize is most real estate is purchased using leverage. If you put 10% down, which you can see here, most of our questions are not for 10% down purchases. If you put 10% down, you've got 10-to-1 leverage. If inflation goes up 2% and housing goes up 2%, you got a 20% return on your money. That's why housing makes people wealthy. Two reasons. The fact that you're using leverage and the fact that you're fixing your housing cost. If we go forward 10 years, California, very high home prices. If you buy, you're going to pay more monthly than the rent would cost absent a very large down payment. But if we flash forward 10 years, inflation will have pushed those rent payments much higher. If you look at U.S. national rent averages versus house payments average much less than renting. Although if you run the numbers in your area, you're going to go, that doesn't work. My house payment is going to be more, but that's because they're talking about the average of Americans' house payment. A lot of those people have really little loans because they bought 5 years ago, 15 years ago, 30 years ago. So I just question the premise, depending on where you're trying to go with it. The fact that you use leverage makes housing a better investment than just about anything, as long as you're not buying at a market top. So we get people here every week that have assured us that we're at a market top and the crash is coming. So if that happens and you are wise enough to sidestep that and buy in at the bottom, you would do better. But you're saying that you don't think inflation adjusted back since 2007, 2008, we've seen actual home price increases. If we can find the number while Jeb's answering some real estate related questions, I'll keep digging here, but it's not easy to answer questions and do the research at the same time.
All right. So I failed to thank Jennifer Lego for being in here. I know she's chatting with a bunch of you guys. She is our moderator. Many of you guys know that who are here each week. So thank you, Jennifer, for being here. I wanted to make sure I mentioned you and say thank you for doing that. Got people debating
whether she a homeowner yet?
She should let us know. She was in contract, so we're getting close. It's been 2 weeks, I think. So we're about 15 days into what could be a 30-day escrow. So we'll find out. Let's see, what do we got? People telling us to shave the beard. Elba Rivera. Thank you. I closed on my home last Wednesday. Josh killed it. Jeb recommended a great realtor. So I put this up here just because she came from the channel. She reached out, got connected with Josh. Josh did the loan. I referred her up to an agent I know in West Hills. They actually second offer they wrote on. They got accepted. It was like a very quick process. Super. The agent I refer, Steve's a good guy and made it happen. So congrats to you on becoming a homeowner, Josh. Nice to get the job done and not making me look bad.
Hey, Elba, let's give Elba some credit. Elba's awesome. I'm not going to name names, but I'm going to contrast her to another buyer that you and I are working with in a very similar price range, who every time you guys find a home that they like, comes with a calculation and tells you what he would like to offer, which is 5 to 10% lower than what you suggest, which almost always ends up being what the home sells for. Elba went out, they wrote one offer. They wrote a strong offer on the first property. Steve guided her. They found a home she liked. They wrote a strong offer. They got outbid. She came back. Next house comes on the market. She writes a stronger offer. Steve is a really good negotiator, got that thing locked up, and we got her transaction closed where other people are still out there fighting. The gentleman we're talking about, or the folks we're talking about in the other situation, have been looking since October. And the markets they're in are up, 10% in the time they've been looking, writing lower offers.
Easily.
And logically, he may be right with the back of the napkin calculations going, here's what I think this home is worth. The market does not care what you think the home is worth. The market cares about supply and demand. And when there's a limited supply of homes you're interested in and lots of people that want it, you have to get serious. And Elba did a great job on that. So she was the more important part of the success than me or Steve.
No, absolutely. Richard, I'm sorry. I'm sorry, Richard.
Call me Yui, please.
I'm sorry, Richard. And someone down here told me not to be racist. I wasn't being racist earlier. I literally just almost pronounced the wrong name, not for any insult reasons. Just that's what I was reading in my head. So Truth is Treason is asking, as a new investor, when would you look to be purchasing? What are signs a new investor should be looking at? So we talk about this all the time. This is a popular question. So investors should think, when they are looking to invest in property, are they looking to gain appreciation? Or are they looking for cash flow? Most markets, it's difficult to get both, right? Now, with short-term rentals, some Airbnbs, you can get both, but you're subject to the city or the area that you're in changing what they allow with short-term rentals, and you owning a property that may no longer cash flows or whatever for that reason. So it's a little bit dicier, but there's some good opportunities out there if you know what you're doing. But let's talk from a standpoint that goes a little bit further back than the most recent when talking about investing. And the reason I say appreciation or cash flow is because in California, you're likely to get appreciation over the long term, right? But it's going to cost you a lot more money to do it. Okay. So the average home price here in Orange County at the moment is probably about $1 million. So buying an investment property, 20 to 25% down, that's going to cost you somewhere between $200,000 to $250,000 down to invest in that property. Go to some states in the Midwest, those homes haven't really appreciated in 20 years. Now, when I say not really, you bought them, 20 years ago, they were 175. Now they're 200,000. Yeah, it's appreciated, but not like California or some of these other markets. And so there you can buy a property, put 20% down on 200,000, right? That's what, 40 grand. And those properties cash flow month over month. Not a huge amount, but you'll get $400 or $500 a month in some of these properties in cash flow on that. So you've got to decide what is the better avenue for you. What's your risk tolerance? There's a lot of factors that go into that. How much money do you have to play with when talking about investing in property? How deep are your pockets? I had a guy call me yesterday that's looking for $8 or $9 million property to invest in. $8 or $9 million. Most people can't play that game, but he knows California coastal real estate long term is a good move, right? So it's a different scenario for each person. So you got to weigh what's better for you and what you're comfortable with. Josh, I know you always have something to add on that. So thoughts?
You covered a lot of the bases, but I started thinking, don't believe that all investors are the same. There's different types of investors. When I was flipping houses, I didn't give you know what about cash flow. If the property was going to cash
Oh,
flow was
Richard.
irrelevant.
Sorry, Richard.
We were looking to see, can I buy it, renovate it, and resell it and cash a check? So if you're looking to flip, you're looking at the biggest margins. You're looking at how much cash do I need to accomplish that, and what's my cash on cash return. Jeb's talking about people that, hey, I have some cash, I'd like to invest in a property, I need a loan. So I need to find a home, I need to know what the rents are, I need to know what my mortgage payment is, then I got to project what I think home price inflation is and how that's going to work out for me in the long run. The craziest one, which is almost the most obvious one, is the hedge funds paying cash for properties. They don't need a loan. They're just buying these things outright because they have more cash than they can put to work and get a decent yield. So if you buy a $300,000 house and the thing can rent for $2,000 a month, that is $24,000 a year. You've got some expenses, say it's 20%. That's another $5,000. You got $19,000 on your $300,000 investment. So we're talking a pretty nice yield on that money. And then if you say it goes up 5%, that's another $15,000 that it went up in addition to the $19,000 of net interest. And we get some tax deductions where we can depreciate that. So all of those things come into play. Those are three very different investors looking for three very different things. The people that I talk to that are saying, I want to pull some cash out of my condo that I bought a year and a half ago so I can invest in real estate, I don't see how that's going to happen. If your condo, you put 10% down and it went up 30%, you've got 40% equity in the home. So you can take 20% of it out. But unless you're going to buy that same exact condo with a 20% down, in most areas it's going to be cash flow negative. So you got to look, for most people, the best thing you can do is buy a 2-unit property as your first home and then convert that to a rental as you move on your way out. But again, million ways to do this. And we had our friend Ricardo in here. Was his name Ricardo? Just saying that he's buying properties at a discount. They always exist. It's just not easy. Like he had mentioned in here, one of his comments after goes, network. Some of the best investors I know are awesome networkers. Some of them that I know are awesome marketers. Some of them have a lot of time on their hands and go knock on doors. Some of them do probate. So there's not really an easy way. You got to figure out what your goals are, what your assets are, and what your skills are, and find that little Venn diagram of where those all intersect.
There you go. Me too. No, Toom. According to U.S. Census Bureau, thank you for the super chat. First off, thank you for that. Home building permits have risen in the past 10 years and are almost identical to 06, 07, 08. Are home building permits a lagging indicator on inventory? Other thoughts? So here's the thing: is builders will continue to build or pull permits to build when there's a lack of supply in the market, right? There's a certain number that they look for. The Logan Makhtashami or whatever his name is has a number that he follows, and he's from Housing Wire and really smart dude. But the data, I forget the number that he looks at with regards to how home builders build homes or continue to pull permits or what have you. So right now there's a lack of homes, 4 to 6 million, depending on what you read out there. So home builders know that now is an opportunity to take advantage of that. The problem is these home builders on average can only build about 1.2 million a year, I think, at like the high side of that. And with, growing population, you know, it's almost impossible for them to catch up with the number of homes that need to be built just to balance out the market. So I don't know if it's a lagging indicator or not, but I just, when I hear people talking about homes being built, my first thing is, okay, there's permits being pulled for homes being built. That doesn't mean those homes are built. I mean, you read the stories that are out there. These homes there's a lot of homes that are under construction that they don't have the supply to be able to finish some of these things. Like I was talking to somebody or reading something recently. There's a home builder in Florida that's getting ready to build a new tract of homes. They have to order windows a year in advance to be able to have the windows to build these homes, so that when they're there, the windows are, I mean, that's how far back some of the supplies are in these properties. I mean, there's homes, I think it was up in Sacramento, that were being completed, but they didn't have garage doors. They didn't have garage door openers. They didn't have dishwashers to put into them because the supply bottleneck. So, labor's a problem. There's a lot of factors out there that go into building these properties. Southern California, probably you're not going to see, a huge amount of properties being built. Now, again, areas like Colorado and some of these areas where, what's her name? Josh, help me out.
Who you got to be more specific than what's her face.
Who are we talking about?
In Colorado?
No. What's her name? That follows home building.
Oh, I don't know where she's at. Ivy Zellman.
There we go. Yeah, she was talking about areas like Colorado and some of these areas where there's a lot of construction, that they're going to see a lot more supply on the market that's going to help ease demand, if you will. It's going to balance each other out. And she thinks that's going to come as early as this summer. She's smart. She knows what she's talking about. Just that sort of thing isn't going to necessarily impact Southern California so much. So you just got to know your market and know how that might affect it if building is coming out there. But Josh, we got a chart up here. Go for it.
The reason why I threw the chart up there is housing units completed. So here's the peak, 2000. What was it, 2005? Oh yeah, I'm on the wrong one. I'm pointing at the wrong thing. So 2006 was the peak. So
Yep.
You're saying we're approaching those levels in terms of permits, but we're nowhere near in terms of actual completion. So that inventory is not coming to the market. The other thing to remember, think about 2006. We're talking 15, 16 years ago. I'm 48. My generation was turning 32, 33, prime first-time home buying age at that point in time, and it was a much smaller generation. So we were reaching peak home building of putting units into the market with a smaller generation coming after the boomers and being a good bit smaller. So it's a perfect recipe for an oversupply. Now you see all this lack of completions through here 2010, and we're catching up. But if we're 4 million short and we're looking at completions at 1.4 million a year, like we're 5, 6, 7 years away. And if you look at this trend, that trend is likely to continue increasing. And that's what Ivy Zellman is saying, is we keep building and completing more homes, and that's going to be a problem at some point. I just don't see that at some point coming super soon, meaning the next 1, 2, 3, 4 years. So we'll see. And like Jeb was saying, Logan Muktashami likes to point out that we have the millennial generation hitting that age 32, 33, 34, peaking all the way through 2024. So we got 3 more years of a big generation, the biggest since baby boomers, coming into prime home buying age. Doesn't mean it can't be a problem, definitely regionally. So if I was in an area, let's say I'm just pulling something out of my rear end and saying, if I'm in Georgia and I want to see if this would be a problem, I want to look at these figures for Georgia and see where they relate, and then also, population of a certain age. But what I can say is all of the southern states are benefiting from population loss of northern states. So those are other things you got to look at. If they're building a bunch of units, home housing units in an area that you live in that people are migrating out of and going to the warmer southern states, it could be a problem. So these are the things you got to take into account. It's not just as easy as looking at just base numbers.
Good stuff. I'm telling me I need to fade my hair into my beard.
Got some lines into it.
Yeah. I'm not trying to be, should I get a chain? I should get a chain.
Someone asked earlier about what type of chain you would recommend.
I saw that earlier, and I was going to go answer that. I mean, you should one that people can see, a big one. with a medallion.
Absolutely.
Absolutely medallion, and like it encrusted with something. Like you should
So,
definitely do that.
on a slightly more important topic, is this damn chart will come up. Of course, it's not wanting to refresh, but we found inflation-adjusted housing prices. And of course, the charts on this page are not showing
Just
up.
throw the link in the chat, and people can go check it out.
Okay, check it out because it's a really good article. It talks about what things have done over time. And over the last 20, 30 years, home prices have absolutely outpaced inflation. The 60, 70 years before the 1970s, they didn't really go up. But the things that we had talked about, the reason why, even absent real home price inflation, you're still better off and will make money in real estate.
Good stuff. I mentioned this at the beginning. Many of you weren't here, so I'm going to throw it up here now. I actually didn't fulfill my promise and put the link in the description either, which I will do here in a second. First time home buyer course tomorrow night, 6:00. Starts at, I said 6:00. Starts at 6. It'll be an hour, 7:00. We're going to talk about all these things: home ownership, the journey, basically the process, what happens during that process. If you want to listen, we're not taking questions, just Josh and I going through these things. Again, we're going to take an hour and do that. I will put the link in the description now, or Josh, if you have it, you can throw it in there real quick as well, so people can hit that and join us if they'd like.
They can just get it at jebsmith.net/webinar, right? I'll type
Correct.
it in.
Yep.
Okay.
Good stuff. All right. Thank you, sir. All right. So let's get some more questions here. Oh, I just did it again. I wanted to put that in there. Josh, any opinion? Well, you're answering a question. We're going to come back to this. Good evening, Jeb and Josh. Would you recommend recommend a property manager for a rental property? I'm new to the game and planning to buy 1 and 2 years from now, or might do a cash out refi. So depends on your tolerance for being able to fix stuff, right? Are you the person that if somebody calls and needs the toilet fixed, you're okay either doing it yourself and or finding the person to deal with it, maybe at midnight or whatever, depending on the type of tenants you have? Just depends on whether you want to be bothered with it or not, is what it comes down to. Maybe it also depends on whether you're in an area to even deal with it, right? I'm looking at buying some property right now, investment property out of state, talking over some numbers, and the property manager there, he charges 10% of the monthly rent. And that's pretty standard. But he deals with everything related to the property. He helps, find the right tenants. He does a lot of the stuff that I would need from a distance done. So you just have to figure out what's right for you. I couldn't manage that property like that. Now, if it were down the street, I would probably do it myself just because I'm familiar with the process and know what needs to go into it. But what happens if the tenants don't pay? Do you know the eviction process? I mean, there's a lot that goes into that question. So just know what you know. And if you don't have the knowledge, then you probably need to hire for it.
Jeb, let me go first say you're 100% correct, and I'm still going to disagree with you just slightly. If it's your first one, I think you have to manage it yourself. You don't have to manage it yourself forever. Do it for a year. See what it's like to screen tenants. See what you like and dislike about them. Look at the tools that are available. Go through that experience. Then if you decide it's not for you, by all means, hire a property manager. But I think you have to do it yourself the first time just to understand what goes into it.
There you go. That's agree to disagree. So the link is pinned to the top if you guys want that for that webinar that I mentioned a moment ago. But Josh, this is the question. Anna Lisa says, opinion on physical loans for physician loans. Physician loans for a new doctor, medical resident, or should I wait until residency is done in 3 years? So physicians, still going through the process of residency. What are your thoughts on getting a loan now versus waiting till the end? I mean, there's a lot of programs out there that, cater to physicians in some form or fashion.
It's mainly all of the big banks and local banks. Their thought process is physician is someone who's likely to be a high net worth individual moving forward. We want to build a relationship with them. So they offer really good terms, generally in the form of not having mortgage insurance on a 5 or a 10% down on a very large loan. They give you a jumbo loan with a low down with a good interest rate with no mortgage insurance. Fannie and Freddie have physicians programs where they will allow us some flexibility in terms of hitting you with student loan debt, which a lot of newly minted physicians have. But if the numbers work, physicians have job security, as long as you're not incompetent and ruin someone's health, you're going to have a job and you're going to make good money. So as long as you know you're on solid financial footing and you can put the down payment and the debt to income ratio works, they're really awesome programs. For us as a broker, it's one of the things we don't have access to, because those big banks, they're trying to build direct relationships with physicians. We can do the Fannie Freddie program, but not the ones that are super advantageous. So it's really not a different decision than any other home buyer has to make. You just have to run the numbers, look at what the offer is. Do I have the money to put down? Am I comfortable with that payment? Can I get a house that works for me?
There you go. Andy says, about to get his license. Will you take me under your wing from the LA area? Always looking for people to hustle, man. So you get it, reach out. We'll have a conversation. Happy to do it. Let's see here.
You guys can collaborate on the listing for the guy's house at Dodger Stadium.
There you go. We can talk about that one. Let's see. Andy already said, at what point do you seek out another agent? I'd hate to be biased against newer agents with less networking, but if I'm a serious buyer and then networking will help, should I consider? So Josh, what are your thoughts on that?
I think it would absolutely be worth talking to another agent. Here's the funny thing. I have these conversations all the time with people who've talked to another lender or they're shopping for lenders. And it's always, self-serving to say, here, I'm obviously the best one for you to work with. But you're going to run into the same thing. If you ask any agent, hey, why should I work with you? They're going to give you their best reasons for why they should work with you. So the question should just be, you can't just say, how big is your network? Say, how long have you been in the business? What industry groups do you participate in? Are you in a coaching program? How big is your office? Right. We have some of these people that work out of their home. They don't network with anyone at the office. And there's nothing wrong with that. They could still be a great agent and they could still go to their board meetings and network there. But some of these people literally, I work out of my home and I sell 2 houses a year. It's a nice little sidelight. Doesn't make them necessarily bad at the technical aspects of the job. It means they're not particularly well suited to serving you in the current market where it's so nuts and you need every advantage you can get.
Well, let's be honest. I mean, I have conversations with buyers every week. I don't work with every buyer I have a conversation with. I'm not for everyone. I'm super pragmatic. I'm very much fact-based. I mean, to the point I think you guys can tell. There's not a lot of warm and fuzzy, and it's not because I'm trying to be like that. It's just that's my personality. So my goal is to help you as a buyer get to the finish line. It's not to make you necessarily feel good through the process. I mean, that sounds really bad, but I want to help you get the home at the best price, negotiate. That's what I'm good at. If you want somebody to hug you and tell you they're sorry when you don't get your offer accepted, unfortunately, I'm not the guy. And so I'm not for everyone. And that's okay. So have conversations with multiple people, figure out who you mesh with. Same thing can be for a lender. I mean, you're not going to mesh with everyone. And there's nothing wrong with that. It's just like anything else. You just got to find somebody that you want to work with that kind of fits your personality or what you're okay to put up with to some extent. And that's really what it boils down to. So do you think anybody here knew I wasn't warm and fuzzy, or did I just surprise everyone?
I just, the funny part was when you said you're not for everyone, and we were all like, yeah, you're not, bro. You're not for everyone.
And hey, listen, I'm okay with
never,
that.
Never claim to be. No, what
I'm
they say,
okay with that.
You don't want to live in the middle. You want everyone to love or hate you. If everyone loves you or everyone hates you, then you're doing something wrong.
Well, then I'm clearly in good shape, guy. I read the comments on some of these videos. People, I am definitely on one side or the other. We are 2 hours into this whole thing. Josh, what do you want to say to the people out there watching at the moment?
Same thing we said last week, and it's largely the same message. It is a difficult market out there. It's an appreciated market, which increases the risk to you. So if you're deliberating and contemplating, that's the right thing to do. What I would say is don't come to a decision of it's right for me and I'm going to get in the market, or it's not right for me right now and I'm going to have a game plan of how I'm going to save and get ahead without being a homeowner right now. Too many people dawdling. They talk about getting pre-approved, or they get pre-approved and then they don't go and connect with the realtor and make offers on houses, or they make 1 or 2 half-hearted offers, they get beat out and they go, oh, the market's too tough. I can tell you, you've probably heard it a couple times in these 2 hours, Jeb and I get offers accepted every day, and it is a difficult market. Elba Rivera showed up here and talked about getting in. It's not easy, it's hard, and it's stressful, but once you do it, it is well worth it. And anyone who tells you, hey, there's no risks in home ownership and there's no way home prices can drop from here, that's not true. There is some risk. We have elevated home prices. I can give you strong reasons, economy wise, of why we don't think home prices are going to drop, and they're likely to continue appreciating, and you will likely make money on it. But that's certainly not a reason for you to get scared and FOMO and just jump in to something you're not ready for. Get some trusted advisors, listen to them, run the numbers, and make the best decision for you.
Great advice, guys. Great advice. I'm throwing the link up here again. Webinar tomorrow night. Guys, it's a lot of what we talk about here, more organized, kind of guiding you through that process, right? I think we're going to touch on each of the key things that you need to know when buying a home. Quite frankly, your agent and your mortgage professional that you're working with should be telling you these things or guiding you through that, but many people don't for whatever reason. So it's something we're gonna to lay out for you in a little seminar there tomorrow night. So register if you have any interest. Hit the thumbs up if you haven't done so already. That gets more people out there viewing the content, helps us achieve the goal of helping and guide people through this crazy process. That's what it's all about. I appreciate you guys being here. Always appreciate the support. Any final words there, Josh?
No, just thanks for showing up, and hopefully we'll see you back here next week. Or hopefully you become a homeowner in the next week and you don't need us anymore.
Or you just show up tomorrow night. We'll see you there too. Anyhow, we appreciate you. We will talk to you soon.